55,000 crores. Now, margin gets diluted, say, from 59 to 57. So my revenues now are 55,000 into 57, which is higher than 50 multiplied by 59, right? And then even if you divide that by 55,000, it might look like that 57 basis points, but the absolute earnings is higher. Our cost, if you look at the costs that are debited to the P&L of the asset management company, they are very different so-called number, right? The numerator there is very different. And once you divide that by the total AUM, that will give you the resultant basis points of spending on our cost. And the residual or the difference between the two will give you the operating revenue. So even in the example that you are citing, the operating profit margin would look equal or better based on the numbers that we discussed.
Sure, understood. Thank you.
Yeah. Thank you.
Thank you. Next question is from the line of Dipanjan Ghosh from Citi. Please go ahead.
Hi, good evening, sir. Hope I'm audible. So few questions. First, this 59 bits that you mentioned, I would assume that is as on the closing AUM of March 31st. So that's the first question. Second would be, I would also assume that the current yields on your fresh equity flow would still continue to be lower than the blended book. So, qualitatively, can you give some color in terms of the divergence or the delta between the fresh versus the blended? How that divergence would have changed over the last few quarters compared to, let's say, April 1, 2024 versus, let's say, last year, April or the year prior to that? How would that have changed? Third would be on the MFDs. If I look at your equity growth through the MFD channel versus others, there has been a significant divergence both for the quarter and also for the year. So is it that your flow market share accretion in MFDs would lag the other channels? Also, in respect of this, I think you have gained in the direct side. And given the current construct where your yields on fresh is lower than blended, every time you gain market, every time your mix in direct increases on the equities, you tend to benefit on the blended yields. So assuming this trend changes in MFDs, business through banks, HDFC Bank revives, can that lead to some amount of margin pressure out there? So those are my questions.
So I think Dipanjan will try to answer. The first question of yours was 59 basis points on 31st March. Yes, that's right. We opened it on 1st of April at 59 basis points. Current yield still lower in terms of flows. Absolutely. The flow margin is lower than the book margin. So the flow margin, as we mentioned on the last call, ranges in the 50 to 60 basis points versus the book at 59 odd basis points that we made a mention of. Third point that you talked about is basically the distribution mix. Now, distribution mix, this is the flows that is coming into us, and this is not about the market share that we get from each of these channels. Now, direct, we have also mentioned that in past, that the book on direct was at the start of the year around 23 odd %, but we have always mentioned that the flow from direct channel is materially higher, somewhere in the 27, 28 or even 30% in some of the months. So because of that, now you are seeing a higher and higher tilt falling in favor of direct plans or the direct as a channel. That also includes fintechs and RIAs. If you look at the pie chart that we have depicted in the presentation, that actually gives you the breakup that we have kind of our AUM across varied channels, banks, MFDs, national distributors. But that does not really mean anything in terms of our market share in those respective channels. And lastly, our margin, whether money comes in direct or through any of the channels, is constant. Right? The management fees as per regulation has to be a constant number. So our margins are not kind of getting impacted by whether the flows come in from direct or from any of the distribution channels.
Simal, just on the last point, if I understand correctly, the direct TER is your gross TER minus the blended distributor payouts on the back book, not on the fresh business. Now, given that fresh business payouts are tad higher compared to the blended payouts on the back book, I mean, very mathematically, isn't the net realizations on incremental direct flows better than the net realizations on incremental regular flows?
No more, I think, because the management fee number between both are be constant by regulation. So that's not the case.
Got it. Thank you and all the.
Thank you.
Thank you. Next question is from the line of Lalit Deo from Equal Securities. Please go ahead.
Yeah, thank you, sir, for the opportunity. So just two questions. One, you have highlighted that we have added people on the alternative side. So just wanted to know what are the different strategies if you are looking for FY25 and FY26 on the alternative side, and any product pipeline for the next year on the NF side?
I told you the total headcount increase was a little over 200. A large number of them were in sales, and also as we expand other channels, like I mentioned, whether in the digital side, whether on the alternatives, on the investment and the distribution side, servicing side, and technology, etc. And your specific questions on alternatives. So last time we mentioned, we gave the update on our fund of fund. We have commitment to the tune of rupees 9 billion from over 300 institutions, family offices, and HNIs, and hope to raise more capital to further expand our product proposition within AIF. We have hired 2 senior resources on private credit side. We do see that category as an opportunity over the next few years. We will soon launch a product there.
Thank you, sir. And on the AMC side, are we looking at any new product launch, any scheme launches over there?
So we are looking at some more thematic funds. So actually, we are going live with the next NFO, the manufacturing fund, later this. So actually, next Friday on 26th is when the NFO opens. So that is something on the cards. And then we'll gradually evaluate if there are any other opportunities that our investment team is comfortable with.
Sure. Thank you.
Thank you.
Thank you. Next question is from the line of Abhijit Sakre from Kotak Securities. Please go ahead.
Yeah, hi, good evening, everyone. My first question is that, what we've seen is that incrementally, I think, retail money is sort of also fluctuating across categories and kind of quick to change preferences, right? So to that extent, incrementally, I think you guys are, gaining a lot of share in, larger priced funds such as, Balance Advantage or large cap or even mid cap. So, at some point of time, do you want to optimize your yields given how, funds move across categories? Or will it always be like a, blended number, and whatever, the number comes out across different funds?
You are saying optimizing by what? Like we encouraging flows in a certain set of funds?
No, see, this is in the context of the fact that, the fund performance is very strong, right? To the extent that a lot of these, people come and ask for these funds, right? So does it make sense to, optimize for yields in the way that you are able to, let's say, better protect your yields at an overall blended level?
So you're talking about the
Commission.
Yeah. Exactly, yeah.
Of course, it's a balance between two. On one side, you have to keep the competitive environment in mind. And on the other side, as you rightly mentioned, we also want to optimize. You're absolutely right. So, we keep looking at both and try to, we don't want to lose out on market share when your performance is good, when your products are approved, and when there is demand or pull for the product. At the same time, we remain very, very mindful of the profitability that we want to maintain on these products. Yeah.
But just broadly directionally, I think where the incremental money is flowing, should we be really, everything else remaining constant, just the blended yield number will have furthermore pressure this year. Would that be a correct assumption?
So Abhijit, I think we monitor yields internally product-wise, right? And we are definitely very, very cognizant of the fact that we need to balance it well. Plus, we don't want to have like a very wildly fluctuating distribution commission policy, right? You need to kind of align yourself because these are same set of your partners who help you in when your performance is slightly muted and otherwise. So I think we balance that quite well. Yields under pressure, I think Navneet kind of expanded on that, right? That is fact of our business. The telescopic pricing is what the regulator has kind of defined for the industry. So that is, but honestly, like more we think about it, we are not really perturbed about with increasing AUM fall in yields because hopefully over a period of time it will get well compensated.
Got it.
Also think about it, Abhijit, that lower TR in that product relative to, let's say, some of our peers would also lead to that much of alpha. And wouldn't the sellability of that product increase over a period of time in our favor?
Mm-hmm.
So there are many dimensions to it rather than looking at from a very narrow perspective of...
Yeah. No, the observation was that, when we look at fund flows across fund houses and across categories, there's a very wide divergence to the extent that, few funds are very clear winners and are gathering a substantial share. So to that extent, is there a case for, better pricing power is what I was coming from.
Yeah,
but I got your answer.
Yeah, because but if you look at most of our products, and I think you can look at just the change of AUM, and I know a lot of you do that exercise in terms of change of AUM and change of NAV. If you look at it in all dominant categories, be it large cap, mid cap, small cap, balance advantage, focus funds, large and mid cap, multi cap, all these categories, we've been getting healthy flows.
Understood. So the second question was that any comment or color around, how the newer fintech channels are now, driving flows, any interesting trends out there?
Yes, I think over the last couple of years, they've become quite prominent, particularly on gathering new SIPs and bringing new investors to the industry. It's a key distribution channel for all AMCs, and it's growing at a rapid pace. In fact, as a group, they have registered 17.7 million SIPs in the current fiscal. We are available across all fintechs and have a healthy market share in new flows and new SIP registrations. We have a dedicated channel which drives the fintech strategy. We have our backend well in place to integrate our platform with theirs. This is already operational and smooth. So with increased product range, all the products that have been launched with strong performance that we have got, with all the marketing efforts that we make, enhanced communication, content, etc., we are confident to get a fair share of this channel.
Got it, Navneet. Thanks a lot.
Thank you. Next question is from the line of Shreya Shivani from CLSA India. Please go ahead.
Thank you for the opportunity. Most of my questions have been answered. I just want one clarification and probably a guidance on the debt AUM. So you've mentioned in the previous few calls about leaving aside the debt index fund that your market share has been stable. What I can gather is from the monthly numbers that have come out that the market share on annual basis between March 23 to say February 24 or March 24 has also largely been stable. So any outlook or how should we look at this segment going ahead? Would it be a more stable segment in terms of market share or any strategy, anything that you can help me understand the segment better?
This is the third consecutive year where debt funds as a category have seen net outflows. So this year was a net outflow. Last year, as well as the year before last, industry has witnessed net outflow in this category for a variety of reasons, including maybe the overall market environment and also maybe the taxation change this year would have also impacted a bit. Maybe some more money would have come this year, but for the change in the taxation. But you might have noticed as an industry, we all believe that there is tremendous potential in fixed income category. This is a long-term track record. Some of our strategies are very old and have a outstanding track record over a period of time of managing credit risk, liquidity risk, and they offer good value to investors from an asset allocation perspective. As an industry, you might have noticed Association of Mutual Fund India, AMFI, as a Mutual Fund Sahi Hai investor education campaign. We've just started a new campaign called Fixed Income Sahi Hai. This is to create more awareness about this category of funds And maybe over a period of time, everyone in the industry, and particularly the players like us who have a longer term great track record and a brand and pedigree, to invest more to cater to that demand as well. I mean, if we compare with the bank deposits, over the last 6 or 7 years, fixed income AUM as a percentage of bank deposits has actually come down. So over a period of time, I strongly believe that there is potential for us to grow in that segment as well.
Got it, sir. And while you mentioned about the net outflows from the industry, I think couple of months in the last year, like Jan, Feb, and probably November or so, there was a positive inflow in that segment, right? I mean, that is a general. I mean, should we count it as something that going ahead this would be a positive sign or a green shoot, or it was just a one-off month for that matter?
Yeah. So some of the investors who take advantage of the interest rate movement in some of the short-term categories, they moved in the first quarter anticipating peak in interest rates, peak in policy rates, and we saw some flows. But as I mentioned, the year as a whole, the industry has seen net outflows.
Got it. That's useful. Thank you for explaining. Thanks a lot.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Ronak Singhi from Reliance Retail. Please go ahead.
Hello, am I audible?
Yes, sir, we can hear you.
Since seeing the current market scenario and all, I've just came across the news that the US Fed rates will decrease in the latter half of 2024. So how do you see this as a potential to increase your debt fund structure, which has been a lower share segment and all, compared to the other players of your group?
Sorry, I didn't get your question.
I think I think there is a bit of disturbance behind you, but you are saying the US Fed rates and the implication on the Indian debt funds?
Yes.
No, he's asking for US Fed rates and what will it happen for the Indian debt funds. So what's the view on US Fed rates? And
yeah, I mean, there is definitely some correlation. Global interest rates or global liquidity scenario is also one of the factors, but also the domestic growth inflation dynamics, fiscal and monetary policy, all of those are also important factors. Our team has a view that interest rates are close to the peak, and over the next couple of years, I think investors should benefit by allocating some money to the fixed income funds. We have seen positive flows into our long-term debt fund this year as some of the investors have committed for longer term locking into the higher rates which are prevailing and the higher current yield which is there in the portfolio currently.
My next question will be like, what's the share of the ETF among your total assets under management?
You're talking about our assets under management? Ronak, we can't hear. You are asking what is the ETF share in our AUM?
Yes.
Yeah, that's around 2%.
Okay. Thank you.
Thank you. So we don't have anyone in the question queue. That was the last question.
Sure. Thanks, Nirav, and thanks everyone for joining the call. Look forward to speaking with all of you next quarter. Thank you.
Thank you very much. On behalf of HDFC Asset Management Company Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.